Hello everyone, and welcome back to 360 Wealth Planners Traffic Report. As we wrap up the third quarter today, we'll review the markets, the recent volatility, and what it all means for your investments. Let's dive right in. To start, let's take a look at where the markets stand as we close the third quarter. Broad equity markets such as the S&P 500 have seen gains over the quarter, while broad fixed income markets like the Treasury bonds have also shown resilience despite some fluctuations. But markets have been turbulent, and the question remains, why? We've seen quite a bit of volatility over the past couple of months. Here are the top 3 reasons why. Number 1, ongoing concerns about inflation and the Federal Reserve's interest rate policy. Number 2, global geopolitical tensions that continue to disrupt supply chains and raise market uncertainty. And number 3, weakness in some key economic indicators such as consumer spending that have fallen short of expectations. These factors have led to some sharp swings, but the good news is the markets have shown some resilience and a quick recovery. Bonds have rallied, but not to the extent that might signal a major shift. Yields remain volatile as markets weigh the potential for further interest rate hikes from the Fed. Historically, markets tend to experience volatility during election years, but generally stabilize after the results as uncertainty fades and investors adjust their expectations accordingly. As for the good news, the economy is still growing, albeit more slowly, and inflation has continued to show signs of cooling down. This could give the Fed more flexibility in its future decisions. Currently, the Fed has indicated it is done with restrictive rates and will continue to reduce rates towards what they call the neutral rate. Markets anticipate the target for the neutral rate to be around 3%. This would lead us to believe rates will continue to decline over the next 12 months. One interesting thing to note is that historically, economic data is much weaker when the Fed begins a series of rate cuts. Currently, the economic data is certainly stronger relative to previous rate-cutting cycles. While there are reasons to be optimistic, it's important to be realistic when planning ahead. In early August, we made strategic moves to adjust hedges and tilt some market positions more conservatively. These changes were designed to better protect portfolios as we navigate the current uncertainties. To further hedge against market risk, we've reduced exposure to consumer discretionary companies and made adjustments to certain market option positions that help manage downside risk in case of significant drops. We are not just heading into, but are already in the traditionally choppy season for markets. Historically, September and October can bring heightened volatility. While we remain cautious, our focus is on positioning portfolios to weather these turbulent times while also keeping an eye on potential opportunities for long-term growth. That wraps up today's review of the markets. As the third quarter comes to a close, stay informed, stay patient, and remember that proactive strategies are key in uncertain times. If you have any questions or want to learn more, don't hesitate to reach out. Don't forget to like and subscribe, and stay tuned for our next update. Thanks for watching.